Now let's talk about the free cash flows. Free cash flow is a very important concept in financial analysis. The free cash flow represents the cash that a company can generate after spending the money required to maintain or expand its asset base. The result shows the amount of cash that can be available for distribution to the investors, including debt holders and shareholders, after the investment for the company's necessary and ongoing operations. It is an important measure of the company's performance because it allows a company to pursue opportunities that can enhance the shareholders' value. Without cash, it will be tough for the company to develop new products, make acquisitions, pay dividends, and pay off the debt. Companies with positive free cash flows, they have funds available to pay to the investors. And eventually, investors care about how much free cash flow a company can generate because that indicates how much they can get out of the company. So as you can imagine, the value of a company really depends on how much free cash flow it can generate and distribute to its investors. If a company shows negative amount of free cash flows, it may suggest this company is investing heavily in operating capital to support the growth of the company. However, if a company shows consistently negative free cash flows all the time, the company may be experiencing some problems in its operating or managerial functions. Free cash flow is estimated as operating cash flow minus the investment in operating capital. The concept of the operating capital, it is the amount of cash flows a firm can generate from its operations after they have paid the taxes. So the OCF is this part. And then the investment in operating capital, we can also call it the IOC. That's the amount companies spend to purchase operating assets, including long-term assets, long-term investment, and short-term investment. What we have here is this part. As we will explain later, this change in gross fixed asset, that's usually for the investment in long-term asset, and here, this is the investment in the short-term working capital investment. So let's look at this equation part by part. EBIT multiplied by 1 minus the tax rate, or say 1 minus T, that's a company's operating profit. Sometimes we call it the NOPAT, net operating profit after tax. And when we add the depreciation back, the EBIT multiplied by 1 plus T, and then adding the depreciation, that's the operating cash flow part. We add depreciation because depreciation is a non-cash charge that was subtracted before we got the EBIT result. So now we add it back. Again, before this minus sign, this part is about the operating cash flows, the cash flow this company can generate from its main operations. After the minus sign, we have the necessary investment. This part, the change in gross fixed asset, that's the investment in long-term fixed assets. And the second part, the change in net operating working capital, that's the investment in net operating working capital. What is the net operating working capital? It is the operating current assets minus the operating current liabilities. You may recall that from the first video in this lecture, we talk about account payable and accrual expenses being the operating current liabilities, or say the spontaneous liabilities, while note payable is not included as one of the operating current liabilities. So we want to focus on the operating part and look at the operating current asset, or say the current assets that are closely related to the company's operations, and the operating current liabilities, the part of the current liabilities that are also closely related to the company's operations. If we subtract the operating current liabilities from the operating current asset, we got the NOWC, net operating working capital. You may notice this is very similar to the net working capital that we mentioned in the first video in this chapter. Net working capital is the current asset minus current liabilities. So it's not necessarily about the operating working capital. So if now we want to focus more on the operating kind of working capital, we focus on the operating part. So that's why only operating current liabilities are included and only operating current assets are included. So now let's look at an example. This is example 2-6 from your textbook. This is about using the information from the balance sheet of this company and the income statement. What would be the company's free cash flow in 2018? So step number 1, we try to find out the part that's before the minus sign, the operating cash flows. So we want to find EBIT, which is from the income statements, multiplied by 1 minus T. Tax rate is about 33.82%. You can find this effective tax rate by looking at the company's tax divided by its EBT. So we can find out the NOPAT, and we add the depreciation back to the NOPAT, and we get the operating cash flow $114 million. Second step is we look at the investment in operating capital, including the long-term investment and short-term investment. What about the long-term part? For the long-term part, we look at the change in gross fixed assets. If you go back to the balance sheet and remember in the balance sheets, last year it was 300 and 1 year later in 2018 it's 368. That means the company has spent $68 million in fixed assets. So the change of gross fixed assets, the change of the gross fixed asset is the $68 million. Now the change of net operating working capital is a little bit more complicated. You may want to again go back to the balance sheets. If we look at the company's operating current asset, including cash, accounts receivable, and inventory, you notice that in 2017 it was 190 and it increased to 205 in 2018. So the difference, or say the change, has been $15 million. That's where the $15 million is coming from. And if you look at the operating current liability, which includes only accruals and account payables, 65 million total in 2017 and 75 million total in 2018. And the difference is $10 million. So these two together, they have increased $10 million in 2018. So if the operating current assets increased by 15 million and operating current liabilities only increased by 10 million, the difference $5 million would indicate that the company has increased an investment of $5 million into the so-called net operating working capital. That's an investment in the operating working capital, say in the short-term part. Long-term, short-term together, a total of $73 million. So now, last step is to put these numbers together. We subtract the investment in operating capital, the total $73 million, from the operating cash flow, $114 million. So the free cash flow for this company turns out to be $41 million in 2018, not the 15. This is a typo on my slides. Now let's look at another practice question just to get a little bit more familiar with this concept and calculation. Question number 11 from the end of chapter 2 problem set. We are looking at an investment in this company and want to evaluate this company's free cash flows. From the income statements, we see that the company made a EBIT of 62, tax rate of 30%. So 62 multiplied by 1 minus 30%. And then if we add the 5 million depreciation, we can find out the operating cash flow. The company's gross fixed asset increased by 32 million. That will be the change in gross fixed asset. Company's current asset increased by 20 million and spontaneous current liability, or say the operating current liabilities, increased by 12 million. So the difference, 8 million, would be the change in the net operating working capital. So once you understand all these, now we just need to plug in these numbers into this equation, and we can find out the operating cash flow, investment in operating capital, and free cash flows for 2018, and the results are presented here. Feel free to pause the video here and try the calculations by yourself and see if you can get the same numbers as mine here. The last financial statement we want to review here is the statement of retained earnings. This is a simple statement that tries to report the details about any changes in retained earnings. So how would retained earnings change? If you look at table 2.5 here, for this DPH Tree Farm, if we go back to the balance sheet, we will see that the balance of its retained earnings at the end of 2017 is 155, and by the end of 2018, or say 1 year later, it becomes 210. So how does it increase from 115 to 210? That is because the company has made some profit or earning or net income, no matter how you want to call it, of $90 million. So this is the number you can find from the bottom of the company's income statement. Out of the $90 million, company paid $10 million as preferred stock dividend, another $25 million as common stock dividend. So that's a total of $35 million dividend paid. And you pay dividend out of the net income. The remaining part goes to the accumulation of retained earnings. So once it's retained in the company, it's added to whatever you already had from the beginning of the year. So 35 adds to 155, that would give you the 210 for the end of the year balance of the retained earnings. Now, if you understand that concept, let's take a look at an example question. We have a company that earned net income in 2018 of 10.78 million, 1 million as preferred stock dividend, and 2.5 million as common stock dividend. So that's a total of 3.5 million. If you pay 3.5 million out of 10.78, so the difference between these two numbers will be 7.28 million. That will be the additional retained earnings in 2018. That number now is added to what the company had at the beginning of the year, and that will give you the new balance for the end of the year. Final number will be 143.03. Once you understand the statement of retained earnings, let's look at another practice question. So we have question number 13 from the end of chapter 2 problem sets. We have this company that had a beginning of the year balance of retained earning of 256 million, so that's 256. By the end of 2017, the company in 2018 has made a net income of 33 million. Out of that, they paid 5 million preferred dividend and 10 million common stock dividend. So 5 plus 10, that's a total of 15 million dividend paid. And if you paid 15 million dividend out of 33 million, that means you have 18 million retained in the company. So this additional retained earning will be added to whatever you already had at the beginning of the year to give you the balance as the end of the year. 256 million plus the 18 million would give you a total of 274 million. Again, you subtract the 15 million total dividend paid from the net income, you get 18 million additional retained earning, and you add that 18 million to 256 to get the 274 million by the end of the year. So by now we have already finished reviewing 4 basic types of financial statements, including the balance sheet, income statement, and statement of cash flows, and the statement of retained earnings. We need to be aware that companies, they can actually try a lot of different things. They can try to smooth earnings. They can use different accounting methods such as a depreciation or inventory valuation method to somehow change or manipulate the earning numbers. And when that happens, the numbers, the results in the financial statements may not be that reliable for investors. So to prevent all those deceptive accounting and management practices, the Congress actually passed Sarbanes-Oxley Act, we also call it the SOX Act, in 2002. It requires public companies to ensure that their audit committees have considerable experience applying the GAAP for financial statements. They also require that the company's senior management sign off on the financial statement of the company, certifying the statements as accurate and representative of the company's financial condition during the period covered. So now the company's CEO and CFO, they have to be personally responsible about the numbers they report on the company's financial statement, and hopefully that would reduce all those manipulative or deceptive behavior and make the financial statements more reliable. Overall, after we reviewed all these statements, you are supposed to understand the basic structure of these statements and be able to do some calculations using the information provided in those statements. And again, our focus is on reading or interpreting the information from those financial statements and use those information to help us understand the company's performance and financial health.